Even with the best strategy in the world, if you don't understand market structure, you will keep losing, because trading is not about predicting the market. It's about understanding who is in control, buyers or sellers, and aligning your trades with them. In this lesson, you will learn how to identify market structure and how to use it to make better trading decisions. Now, let me show you exactly what you will learn in this video. In this video, you will learn how to identify trending market structures, how to understand buyer behavior during uptrending markets, how to identify range-bound markets, how to trade each market condition correctly, the Wyckoff market structure phases, how to apply the TLS trading method, how to combine market structure with support and resistance, how to use candlestick patterns to confirm your entries. What is market structure? Market structure is simply how price moves, nothing more. It's the way the market forms highs and lows. Look at any chart. Price is always doing one of three things: going up, going down, or moving sideways. And as it moves, it creates a sequence of highs and lows. Market structure helps us understand who is in control of the market, whether it is buyers or sellers. And based on this information, we can plan our trades in a more logical and professional way, instead of guessing where the market might go. When the market is moving up, it starts forming what we call higher highs and higher lows. This type of movement is known as an uptrend, and it clearly shows that buyers are in control of the market. However, it is very important to understand that an uptrend does not move in a straight line. The market does not go up continuously without stopping. Instead, it moves in a repetitive cycle. First, we have a move upward, where buyers are actively pushing the price higher. This move is called the impulsive move. It reflects strength in the market, because buyers are dominating sellers and driving the price up. Then, after this move, the market does not continue going up immediately. Instead, it starts to move down slightly. This happens because some buyers begin to take profits. As they close their positions, the price temporarily pulls back. This movement is called a pullback, or a retracement. So in an uptrend, the market is constantly alternating between these two phases: an impulsive move upward, followed by a pullback. Now let's look at a chart to understand this better. Here, you can clearly see the first move upward. This is the impulsive move, where buyers are pushing the market higher. After that, the market starts to move down slightly. This is not a reversal, but simply a pullback caused by profit taking. Once this pullback is completed, the market prepares for the next move upward. This is where many traders make mistakes. The most important question now is, how do we trade this structure? The correct approach is not to enter randomly and not to trade against the trend during the pullback. Instead, we wait patiently for the beginning of the next impulsive move, because this is where the highest probability opportunities appear. Let's look at another example. As you can see, the market is trending upward. It makes a strong move up, followed by a pullback. Then it moves up again, followed by another pullback. This pattern keeps repeating itself. If you do not understand that these downward moves are simply retracements, you might think that the market is about to reverse. As a result, you may enter a trade against the trend during the pullback. But what happens next? The market resumes its upward movement, the next impulsive move begins, and you get stopped out. This is exactly why understanding market structure is so important. It helps you stay aligned with the dominant side of the market and avoid trading against it. Now the question is how to identify the beginning of an impulsive move and the end of a retracement. This is where support and resistance become extremely important, because they give us a clear reference point on the chart. If you want to understand this concept in more detail, you can check the previous lesson where I explained support and resistance step by step. But for now, let's focus on how to use them within market structure. Let's look at this chart example. As you can see, the market moves upward and then starts to reverse. This first movement to the upside is what we call the impulsive move, where buyers are pushing the price higher. After that, the market starts to move down, which is simply a retracement caused by profit taking, not a reversal. At this point, we identify an important area where the market previously reacted. This is where we place our resistance level, because this is the zone where price stopped going higher and reversed. This level is called resistance, because sellers were strong enough at this point to push the market down. Now look at what happens next. The market starts moving up again with strength, creating another impulsive move, but this time, something important happens. Price breaks above the resistance level. This is a key moment in market structure, because once resistance is broken, it does not remain resistance anymore. It turns into support. The reason behind this is simple. A level that previously stopped the price from going higher is now being accepted by the market as a new base. Buyers are now willing to enter at this level, which changes its role completely. Now, when the market starts to retrace again, it does not move randomly. Instead, it comes back toward this level that has now turned into support. This is where we shift our attention, because this level becomes a reference point to identify the end of the retracement. As price reaches this support level, we start looking for signs that buyers are stepping in again. And as you can see in this example, the market reacts at this level, gets rejected, and then starts moving upward again. This movement marks the beginning of the next impulsive move. So instead of entering randomly or chasing the market, you are now waiting for price to come back to a key level, and then you position yourself at the moment where the next move is likely to begin. At this stage, you already have 3 very important skills. You know how to identify an uptrend, you understand how the market moves within that trend through impulsive moves and retracements, and now you know how to use support and resistance to determine when to plan your trades. We will go deeper into this concept throughout the video and refine this approach even more. So make sure you keep watching and do not skip any part, because by the end of this lesson, you will be able to look at any chart and understand what the market is doing with clarity and confidence. Now let's move to the downtrend. A downtrend is simply the opposite of an uptrend. Instead of the market moving higher, it starts moving lower by forming a sequence of lower highs and lower lows. This structure clearly tells you that sellers are in control of the market. In this case, the psychology is reversed. Instead of buyers pushing the market up, sellers are the dominant force. They sell at higher prices and aim to buy back at lower prices, which is why the market keeps dropping over time. Just like in an uptrend, a downtrend does not move in a straight line. The market moves in a repetitive cycle. First, we have a strong move downward, where sellers push the price lower. This movement is called the impulsive move. It reflects strength from sellers as they are dominating buyers and driving the market down. After this impulsive move, the market does not continue falling immediately. Instead, it starts to move upwards slightly. This happens because some sellers begin to take profits, which causes a temporary rise in price. This upward movement is called a retracement or a pullback. So in a downtrend, the market is constantly alternating between these two phases, an impulsive move downward, followed by a retracement upward. Now the question is, how do we identify these phases and trade them correctly? Once again, we use support and resistance as our main tool. Let's look at this chart example. As you can see, the market moves downward, creating an impulsive move. Then it starts to retrace upward. At this point, we identify an important area where the market previously reacted. This is where we place our support level, because this is the zone where price initially paused before continuing lower. Now pay attention to what happens next. The market makes another strong move downward and breaks below this support level. This is a key moment, because once support is broken, it does not remain support anymore. It turns into resistance. The reason is simple. A level that previously acted as a floor for the price is now being accepted as a ceiling. Sellers are now willing to enter at this level, preventing price from moving higher. Now when the market retraces upward again, it does not move randomly. It comes back toward this level that has now turned into resistance. This is where we focus our attention, because this level becomes a reference point to identify the end of the retracement. As price reaches this resistance level, we start looking for signs that sellers are stepping in again. And as you can see in this example, the market reacts at this level, gets rejected, and then continues moving downward. This marks the beginning of the next impulsive move. So instead of entering randomly or trying to catch a reversal, you are now waiting for price to retrace into a key level and then positioning yourself in the direction of the trend. We will cover all of this in detail throughout this video, so stay tuned and do not skip any part, because every section will help you understand market structure more clearly and apply it the right way. Now let's move to the third type of market structure, which is the range-bound market. A range-bound market is a market that moves horizontally between two key levels, support and resistance. Instead of trending upward or downward, price stays within a defined zone, moving back and forth between these levels. This type of structure tells you something very important about the market. Buyers and sellers are in balance. No one is in control. Buyers are not strong enough to push the market higher, and sellers are not strong enough to push it lower. As a result, price gets trapped between support and resistance. Let's look at this chart example. As you can see, we have a clear resistance level at the top, where price repeatedly gets rejected, and a clear support level at the bottom, where price finds buying pressure. The market is clearly moving between these two levels without breaking out. This is what a range looks like. Now, when the market is in this condition, we do not trade randomly inside the range. This is one of the biggest mistakes beginners make. They enter trades in the middle of the range without any clear edge, which leads to inconsistent results. Instead, we wait patiently for price to reach either the support level or the resistance level, because these are the areas where the market is more likely to react. Let's look at another example. Here, the market is clearly ranging, price moves up and eventually reaches the resistance level. At this point, we see a rejection, which tells us that sellers are defending this level and that the market may move back down towards support. This creates a potential trading opportunity because the market is likely to continue moving within the range. And as you can see, after rejecting the resistance, the market moves downward and reaches the support level, exactly as expected. However, it is important to understand something here. This information alone is not enough to take a trade. Just because price reaches resistance or support does not mean you should enter immediately. You still need confirmation, which we will cover later in this video. For now, the goal is simply to understand how a range-bound market works. Price moves between support and resistance. Buyers and sellers are balanced, and your role as a trader is to stay patient and wait for price to reach key levels before making any decision. Now that you know how to identify market structure, let's use this knowledge to actually trade the market. We'll start with the first strategy, which is the TLS method. TLS stands for Trend, Level, and Signal. This is a very simple and powerful framework that helps you avoid random entries and trade with structure and confirmation. To apply this strategy, you need three things. First, you identify a clear trend. Second, you wait for price to reach a key level. And third, you enter the trade only when a valid signal appears. Let's look at this chart example. As you can see, the market is trending downward, which means sellers are in control. The market makes an impulsive move downward, showing strong selling pressure, and then it starts to retrace upward. This retracement happens because some sellers are taking profits, which temporarily pushes the price higher. At this point, we identify an important level on the chart. We draw a support level where price previously reacted. Now we wait and observe what happens next. As the market continues, we see another strong impulsive move downward, and this time price breaks below the support level. This is a key moment, because once support is broken, it becomes resistance. Now we have two important elements of the strategy. We have the trend, which is clearly a downtrend, and we have the level, which is the previous support that has now turned into resistance. The only thing missing is the signal. Now look at what happens next. The market starts to retrace again and moves back toward the resistance level. When price reaches this level, we see a clear rejection, forming a pin bar candlestick pattern. This rejection tells us that sellers are stepping back into the market and defending this level. This is our signal. Before entering the trade, we add one more layer of confirmation by checking the higher time frame. Since this chart is on the 5-minute time frame, we switch to the 30-minute chart to get a broader view of the market. As you can see, the market is also trending downward on the higher time frame, which aligns with our analysis on the 5-minute chart. This alignment increases the probability of the trade. Now we go back to the 5-minute time frame to execute the trade. We enter at the close of the signal candle, place our stop loss just above the resistance level to protect our position, and set our target at least twice the risk we are taking, ensuring a minimum risk-to-reward ratio of 2-to-1. And as you can see, after entering the trade, the market continues moving downward and reaches the target. This is how the TLS method works. You identify the trend, wait for price to reach a key level, and then enter only when you get a clear signal. This approach allows you to trade with the market, not against it, and helps you avoid low-probability setups. Now let's move to another example. In this case, we have a clear uptrend. The market is making higher highs and higher lows, which tells us that buyers are in control. So instead of looking for selling opportunities, the best trading decision here is to focus on buying the market and trading in the direction of the trend. As the market moves, we can clearly identify an impulsive move to the upside, where buyers push the price higher with strength. During this move, price breaks above a previous resistance level. This breakout is an important signal because once resistance is broken, it no longer acts as resistance. It turns into support. After the breakout, the market does not continue moving up immediately. Instead, it starts to retrace. This pullback happens because some buyers are taking profits, which temporarily pushes the price downward. However, this movement is not a reversal. It is simply a retracement within the uptrend. Now we wait and observe how price behaves when it reaches the support level. As you can see, once price comes back to this level, it reacts and forms a tailed bar. This pattern shows that buyers are stepping back into the market and taking control again after the pullback. This is our signal. But before entering the trade, we always want to confirm our idea using the higher time frame. Since we are trading on the 5-minute chart, we switch to the 30-minute time frame to get a broader view of the market. As you can see, the market is clearly trending upward on the higher time frame as well. This confirms that buyers are in control not only on the lower time frame, but also on the higher time frame. This alignment increases the probability of the trade. Now we switch back to the 5-minute chart to execute the trade. We place our entry at the close of the tailed, set our stop loss below the support level to protect our position, and target the next key level on the chart. And as you can see, after entering the trade, the market continues moving upward and reaches the target. Now let's move to the range-bound market. In this type of market, we do not apply the TLS method in the same way we do in trending conditions. The reason is simple. In a range, the market is not clearly moving in one direction, so the concept of following a trend becomes less effective. Instead, we approach the market differently by focusing on how price behaves between support and resistance. Let me show you how we trade it. Look at this chart. As you can see, the market keeps reacting from this area at the top and this area at the bottom. Price gets rejected multiple times from resistance and finds support multiple times at the lower level. This clearly shows that the market is not trending. Instead, it is moving sideways between these two zones. This is what we call a range-bound market. In this type of structure, buyers and sellers are balanced and price keeps moving back and forth between support and resistance. Now let's focus on what happens next. The market moves down toward the support level, and once it reaches this area, it gets rejected, forming a clear bullish-tailed bar. This rejection tells us that sellers were unable to push the price lower and buyers are stepping in to take control. This creates a potential trading opportunity because in a range, price often moves from one side of the range to the other, in this case from support back toward resistance. This is what makes it a low-risk, high-reward setup because you are entering near the bottom of the range where the market has already shown a strong reaction. However, before entering the trade, we still need to confirm our idea using the higher time frame. Since we are trading on the 5-minute chart, we switch to the 30 minutes time frame to get a broader view of the market. As you can see, on the higher time frame, the market first breaks below this support level and then moves back above it, creating a clear liquidity sweep. This signals that a new uptrend may be beginning, which supports our trade setup on the 5-minute time frame. So now we have alignment between the higher time frame and the trading time frame. Now we go back to the 5-minute chart to execute the trade. We place our entry at the close of the tailed bar, set our stop loss just below the support level to protect our position, and target the next key level, which is the resistance of the range. And as you can see, after entering the trade, the market moves upward and reaches the target. Before we continue, there is an important point you need to understand. All the examples I have shown you so far are winning trades, but this does not mean that this strategy is a holy grail. You will have losing trades, and that is completely normal. What really matters in trading is not the number of winning trades, but how you manage your risk and your capital. Even with a simple strategy, if you control your losses and let your winners run, you can be consistently profitable over time. In this case, we have a range-bound market. Price is moving between support and resistance, just like we discussed earlier. But something different happens here. The market breaks below the range and starts moving downward. Now the question is, what should we do in this situation? The answer is simple. We do not chase the breakout. Instead, we wait for a pullback. Look at what happens next. After the breakout, the market starts to retrace. It comes back toward the level that was previously acting as support. But since this level has been broken, it now turns into resistance. This is a key concept in market structure. Now, once price reaches this resistance level, we look for a signal. And as you can see, the market forms a bearish pin bar. This shows that sellers are stepping in and rejecting the level, indicating that the market is likely to continue moving downward. This is our signal. Now we execute the trade. We place our entry at the close of the bearish pin bar, set our stop loss above the resistance level to protect our position, and target the next key level on the chart. And as you can see, after entering the trade, the market continues moving downward and reaches the target. For now, I want you to stay focused on what really matters at this stage, which is understanding trending markets, how to trade them, and range-bound markets, and how to approach them correctly. I hope this video helped you understand market structure in a clear and practical way and gave you a solid foundation to start reading the market with confidence.